the management of TCI, who's here to talk a little bit more about the FASTag corrections, which are at record highs, the supply chain bottlenecks, and logistics policy. Vineet Agarwal is the Managing Director of Transport Corporation of India, now joining us on the show. Thanks so much for taking time out. I'm going to get straight down to it. You had given a guidance of 10 to 15% growth in the second half. Is that a little bit conservative given the fact that the second half is expected to be better for the logistics sector, and even the trends from the FASTag collections seem to be suggesting that?
Yes, hi, good morning. It's always a pleasure to be here. I think the first half of the year has been quite good, as much as we expected in terms of because of the base effect was there as well. The second the second half of the year, we are also going to see a base effect, which is the higher end of the base effect. So our full year guidance was about 15% on the top line, about 10 to 15% on the bottom line. And we are sticking with that because we do see that the larger base from the previous year is going to maybe play a little bit on the Q4 of the year.
Okay, fair enough. What about your performance of the supply chain segment in Q3? Because last quarter, you recorded the highest quarterly revenue and a margin improvement of 50 basis points. Can you walk us through how you see your margins grow and what you're expecting in terms of revenue momentum?
Yes, absolutely. I think what has happened in our supply chain business in the last maybe 2 to 3 years is that we do a lot of work in the automotive supply chain, from the inbound logistics to the outbound logistics, including spare parts logistics as well. And what we've seen is that with the auto sector not doing too well, also the chip shortage, there has been a lot of pent-up demand. And that pent-up demand is really playing out this year, where we are seeing very robust growth. And this is not just the four-wheeler side, but also we do work in the tractor segment, the earth-moving equipment segment, or even the commercial vehicles. I think all of them are doing reasonably well, and that is also helping our business. So definitely this year also will help the growth of that business, and we should look at record quarters in the next 2 quarters.
Okay. Now, the Seaway segment, that has been historically your highest margin business. It garners the strongest margins within the entire company. But recently, the margins have come off. Can you just detail whether or not you're seeing pressure? What is the margin trend from this segment?
Our Seaways business, we operate 6 ships, 3 on the west coast and 3 on the east coast. And these are basically all container vessels. And since we are in the domestic market, we are really not affected by the international freight rates. As you know, those have really come off globally. However, we did do a few trips overseas last year. So there's a little bit of a base effect from that in this year. The other thing is that we had several ships for dry docks in the Q2 of the year. And that affected some amount of revenue growth as well as profitability. But now all the ships in the Q3 are back in service, and we are seeing good traction. The domestic freight rates are quite robust, and as well as there is a lot of demand that is also coming. So we are expecting very good growth also in the Seaways business in the next 2 quarters.
Also, in addition to your ship fleet, we understand that those additions have been delayed because of multiple aspects. The cost of acquiring a ship remains elevated. Wanted to understand, by when is it that you will add new ship? And are you waiting for the cost of acquisition to come down in the first place?
That's right. Actually, we have a capex plan of 250 to 300 crores this year, which includes the purchase of a ship, which will be approximately 100 crores plus containers. And that is getting delayed because though as I said, the global shipping container rates have fallen, the global prices of the ships that we typically buy, the second-hand ships from the global markets, that has not come off yet. Our expectation is that towards the fag end of Q4, we should be able to acquire one, but it is looking even more unlikely. And I think this is a trend which will now, with more ships coming around in the global market in the next financial year, in 2023, we should see this coming down, and then we should be able to purchase a ship. I think we have to also look at that at such high rates, the viability of a ship for the next 10, 12 years in terms of its life is not going to be very high. So that's why we are a little cautious on this kind of investment right now.
Sure. But tell me, Vineet, we were just chatting with the JNPT, and they say that their container volumes continue to remain weak. In fact, they are the lowest in about last 7 months. What kind of trends are you seeing?
So our business is mostly domestic, and 99% of our revenues come from the domestic market. And what we are seeing essentially that the domestic market is still quite robust. The EXIM market is definitely slightly weak. The domestic market with strong consumption growth. See, I think we have to see in terms of not what happened in a quarter or in a season, but a little longer perspective. And for the year or for 2 years, the growth has been quite positive. We are also seeing things like the auto sector picking up. I think the government capex is really, really helping because that is driving a lot of demand in several areas. For example, the engineering side or even in electricals. If there's metro projects being developed, it would lead to steel requirement, it would lead to electrical panel requirement, cables requirement. So I think the B2B side of the business generally in the country is quite robust. And overall, we see that some inflation pressure is there on the consumer side of the businesses, but that is still moderated yet.
And just tying in with that, the National Logistics Policy, along with the Gati Shakti program, has already been announced. What else are you expecting from the budget this time?
Well, there's a lot that's happening in these two itself. So, the National Logistics Policy, the principal aim is to bring down logistics cost. And the one major area where logistics costs can come down is when you shift the mode of transport of freight. 65% today moves by road and 6% only by coastal shipping. So when this shift starts happening, not only will we see logistics costs come down, but also it is green logistics. And the Gati Shakti is actually helping to build those multimodal logistics infrastructure, the assets that are needed. And those in couple with the logistics policy, we should definitely see a great next few years in terms of logistics. What possibly is needed from the budget is this continued capex on building these assets, on infrastructure assets, because any kind of infrastructure assets will ensure that we are able to keep up growing faster and not really building for the past, but building for the future.
And finally, given the fact that Blue Dart just very recently gave a warning for the next 6 months in terms of the business environment, are you also sending out any warning signals? How are you looking at the overall industry from that point?
No, not really. See, a lot of our business is B2B, and B2B side, as I just explained, is quite robust. Several businesses that you just talked about are very heavy focused on the consumer side. And that might have an impact because of inflation. But we see a good, robust growth in several areas, like I just mentioned metro or chemicals, or a lot of areas where the manufacturing strategy of the government, the PLI schemes, etc., are starting to play around now.
Okay, thanks very much for taking time out, joining in and giving us an all-round view on how business is shaping up, as well as the outlook on your overall margin levers and guidance.